Thanks for joining us. I'm in conversation with Bhanu Baweja of UBS. Bhanu, pleasure having you on Bloomberg. Thank you for joining us today.
Great to be here.
All right, let me begin this conversation about, we're talking about a time when global central banks are turning off the liquidity tap. And you are seeing some nervousness creeping in after what's been an extremely strong year. What's your sense of risk at this point in time? Is risk slowly getting off the table?
Look, I think we have to distinguish between liquidity and fundamentals. I think that's true for India. I think that's very true for the rest of the world as well. I don't think liquidity is likely to be turned off in a material way. Yes, the price of money is changing as the Fed is moving slightly. The long end in the US is not likely to move aggressively, and that's an important call, right? Usually what hurts emerging markets in a big way is if the long end in the US, the 10-year yield moves a lot. If the front end, if the Fed policy rate moves up a little bit, it's not as consequential as the long end. And we don't think the long end is likely to move aggressively. As far as central bank money goes, the BOJ and the ECB will still be continuing. The ECB will taper modestly, but they will still be continuing. In 10 years' time, central bank balance sheets as a whole are not going to be a whole lot smaller than where they are right now. The decline in the Fed balance sheet is also going to be lower. So valuations have kicked up tremendously. The question is whether growth can grow into, or earnings can grow into those valuations. What is happening globally is that the epicenter of reflation, which really this year was China, is now slowly shifting westwards. The ideal case for global economy and for emerging markets in particular is where China is very robust and the US is moderate, not very strong, because you want lower cost of capital, which is driven by the US, and stronger growth, which is driven by China. Now that epicenter is shifting away from China to developed markets. And as that happens, there are a few levers that are likely to shift in a manner that's going to hurt parts of emerging markets. The overall sentiment for emerging markets and also for global equities, I think, is likely to remain reasonably strong. Although the tailwinds that were behind us this year will certainly moderate, which means lower returns next year, but not necessarily deeply negative returns. Lower returns, but still in a context of reasonably strong global growh.
Okay, let me push that point a little further. I was just looking at the emerging market index this year. Has returned like 29%.
Yes.
The MSCI emerging market index, that's nearly double of what it's done for its global peers. Some people believe that there's juice left in this rally.
You see, I think we need to sort of analyze what the rally has been driven by. So we spoke about a fairly favorable macro setup. In fact, a very favorable macro setup. Correct. And despite that, the macro actually gets the award for best supporting actor. The true hero has actually been the micro, by which I mean one sector, technology, IT services, has driven pretty much the entire game. You see, I mean, 50%, 55% of MSCI EM has been driven by one sector, which is tech. 3 countries, China, Korea, Taiwan, which are very tech-heavy countries, have driven nearly 80%. So I think one of the big calls we'll have to make is not just where the US 10-year goes, where Euro-dollar goes, and so on and so forth. I think one of the biggest calls we're going to have to make is whether technology is in a super cycle, AI, cloud computing, and electric vehicles, and so on, or it's just in the strong phase of a cycle. There are very strong arguments on both sides. Our view is that it is a cycle, not a super cycle, in that parts of hardware, I'm not talking about internet platform companies and so on, but parts of hardware are likely to be oversupplied by Q1 or Q2 at the very latest next year, which particularly memory, and that is likely the high beta element in the entire tech rally, and that's likely to pull down tech, which again is likely to change to a certain extent or dampen sentiment to some degree. So this year we've had tech, we've had very strong growth from China and low yields. Some of that is changing.
What can then, Bhanu, spook investors? Is it rising oil prices? Is it China? Or is it what the Fed does? I mean, you've seen some people indicate that the yield curve flattening is indicating early warning signs of a potential slowdown, or anything else.
Yes. So, look, I mean, at a very basic level, this cycle has been driven by 2 major pillars. One is a robust China, and the other is low inflation in the US. And logically, therefore, one of these 2 going the other way is going to spook investors. China has had sort of many fans being won over this year. People are pretty happy with even a modestly lower Chinese growth because they think that the volatility in growth is coming down. I think what will really spook investors is if we discover what economists call the Phillips curve relationship in the US, which means that if as unemployment continues to go down perhaps to 4% and even beyond that possibly, you do begin to see core PCE inflation in the US picking up, which it hasn't. Remember, this year, you began the year with inflation at 1.7% core PCE. It declined very quickly to 1.3%, and that really supported yields coming down and valuations kicking up. You're not going to have that next year. Core PCE is already at 1.3%, likely to pick up although slowly, it's likely to pick up from here. The surprise would be if it picks up quickly and more aggressively, and that can certainly spook sentiment, not just in India or in Korea or in Brazil, but globally, I think. But given that emerging markets has been the high beta part of that rally, it stands to be hit more were that to happen. If inflation was to come back and we discover the Phillips curve relationship, that would certainly hurt sentiment.
Let's talk India, Bhanu, and one of the important pillars of the India story has been benign oil prices so far.
Yes.
You've seen that moving up. How are you feeling about India macros, and are you nervous about if oil shoots up?
I am nervous, certainly from an India context. I mean, there's a very clear relationship between India's relative performance to emerging markets and oil prices, and I'm quite nervous about that. And I'm quite nervous about that in the context of what's happened in geopolitics in the Middle East, right? Especially in the last month or so, a lot has changed in Lebanon, a lot has changed in Iran, a lot has changed particularly in Saudi Arabia, that one can't take for granted that you won't get volatility in oil prices. Typically, when oil prices shoot up aggressively for supply side reasons, they come down equally aggressively in T+1.
Sure.
But nonetheless, I mean, that induces tremendous volatility. And at these levels of valuations in India, you don't have much room for error. So I think the risks for oil prices are increasing. As a base case, obviously, since it is an unknown, you don't think about oil prices going to 80 because of geopolitical worries. But I think the risks along those dimensions are increasing. And I think investors should be wary of that.
So you believe that stocks in India have gotten far too expensive?
I think that's not a case just for India. I think that's a case globally. As I said to you, the discount rate globally has remained extremely low, and in fact, you could argue it has fallen even further from very low levels. So I think valuations are expensive in India, unambiguously, but valuations are expensive everywhere. The question is, are we reverting to the mean of valuations anytime soon? And I think we won't. Right? India has idiosyncratic reasons why that won't happen. The mutual fund money, which has continued, I think it can continue for a while yet. But globally as well, the cost of capital has fallen, and therefore for us to say that S&P is at 1.5x when x is the mean and it's going to go back to 1x, I think that is at best a 5-year comment. It's very difficult to see the cost of capital adjusting upwards in a hurry, given the kind of disinflationary pressures that we still have in the global economy.
You alluded to mutual fund money. It's been a milestone year as far as MF flows for India is concerned. You have seen, however, foreign institutional money sell out in the last couple of months at least. Do you see emerging markets continuing to be a favorite for FIIs, and will India find favor in 2018?
So 2 questions there. The first question, emerging markets, I think they will remain in favor, at least in the near term. I think the triggers that actually get people to turn the other way would be a turn down in the tech cycle. As I said to you, that has been sort of the core of what this rally has been driven by. That possibly can happen in Q2 of next year, because what I don't believe is that we have an emerging market growth renaissance.
Correct.
I don't think we have that at all. In fact, this year it has very largely been commodity countries like Brazil, like Argentina, that have done extremely well in terms of growth. You haven't had a growth renaissance elsewhere. Again, it's been valuations ticking up. What kills that is if growth in the one sector that has driven all of this turns down substantially, and that would have to be tech. There's a strong risk of that happening in around Q2, but in the very near term, I think that sentiment remains positive for emerging markets. Now, does sentiment become much more positive towards India? As you said, the locals have been buying, the foreigners have been selling. In a world where the US is taking on the baton of growth from China, India actually stands in pretty good stead, because India's cost of capital is not driven entirely by the US.
Right.
If you look at the 10-year G-Sec in India, it doesn't have a beta of 2 to US yields, unlike a Turkey, unlike a South Africa, where you're very financially geared to the US. So in a sense, India is more operationally geared to the West than it is financially geared to the West. So it benefits from the West improving, but it doesn't hurt from the cost of capital going up in the West. So I think people will get a little more positive in India and a little less positive on the high beta places in EM. They will get a little more positive. But the question again remains, the valuation versus reality gap is wide everywhere. It's particularly wide in India. So in that sense, I think India, particularly relative to the rest of Asia, is going to be a neutral at best for most investors, rather than a tactical overweight. The structural overweight, I think people understand that, the demographic story and the staple story, I think that will remain in place. But tactically, there isn't a switch that will get India to get, that will get emerging market investors to get tactically overweight India anytime soon.
You alluded to yields as well. They've spiked about 7% here in India on the back of the bank recapitalization plan, and that you're going to see fresh supply paper coming into the market. Where do you see India bonds going?
Look, I should give you the context. We're not looking for a very big backup in the US, in Japan, or in Europe, right? Of these 3 we probably think that Europe is one place where bonds are most expensive, and we're likely to see bonds moving up by about 45 basis points. In India, we think we see a backup of about 25, 30 basis points, and we'd be happy to buy it beyond that, because I think the RBI is quite focused on providing positive real rates. I think that's one of the key pillars of the way they're thinking about increasing money multiplier, increasing the stock of money out here. You want to move away from physical assets into financial assets. And why do you want to do that? Not because you want to push the stock market higher, but because you want to increase money stock in the economy, actual legitimate M2 in the economy, put that through the money multiplier, increase investment, increase savings rates, and therefore push up growth. Given the fact that the RBI wants to give you that relatively stable real yield, unless we get an oil shock, which will really wreak havoc on inflationary expectations, because food prices will also be related eventually to that. Unless we get that, we think that 25 to 30 basis points back up from here will present a buying opportunity, and we'd be getting long India bonds, because we think we're very happy with the way RBI has conducted monetary policy. It remains quite independent, remains very focused, as I said, on providing a real rate of return to savers, which I think for duration holders is good news.
My last couple of questions, the rupee. The story of the rupee this year has been a study in contrast. The first half of the year, you saw the rupee getting extremely strong, and then suddenly you've seen this weakness creep in. And the context is widening trade deficit, rising oil prices. Do you see the rupee weakening from these levels?
I do, and let me say this clearly. I think the rupee is uncompetitive, right? It is not a very competitive currency at all. Yes, you have stable balance of payments, but that's because imports had collapsed. But if you think about export competitiveness, and sometimes it's not just the algebra of the BOP that drives the currency, sometimes it is about capital flows, and it is about export competitiveness. Correct. And India doesn't have strong export competitiveness. Export volumes have not been growing at any stronger pace than global imports. In fact, for a while they had been growing less than that. So I think the rupee does need to weaken. So it's not going to be a disaster if the rupee weakens 5 to 7% from here. So despite the fact that we're not looking for a significantly stronger dollar against the euro, against sort of global currencies, we are looking for a weaker rupee, right? We think that this gets to 67, 68, which is broadly in line with the forwards, but in my mind, the risks to that are squarely to further downside for the rupee. So I think the rupee is uncompetitive.
One final question, Bhanu. Your top trades for 2018, your EM top trades. Does India feature in that list?
Unfortunately not, because as I said, I'm going to go into India with a neutral rather than the very strong overweight. We're still looking for places where the growth delta is likely to be quite positive, and valuations haven't adjusted as much as they have in India. Look, the growth delta in India is also going to be positive. The bar is very low. I mean, growth has been very weak, so the bar is very low. But valuations have already moved well ahead of that because of the mutual fund flows we've been speaking about. So earnings will have to grow into these valuations, whereas in other places, for instance in Brazil, for instance in Russia, you have growth delta and the valuations are not that strong. And for the near term, North Asia, driven by tech, remains quite strong. So North Asia, Brazil, Russia, these are the places we are relatively overweight. India is a neutral for us. It would have been worse had it not been for the fact that India actually does stand in good stead when the global economy is picking up and the cost of capital is rising. But I think valuations out here being as high as they are, sort of in the Asian context especially, that means that it's likely to be a neutral rather than an aggressive overweight. So it doesn't figure in the top 10 trades for us.
Bhanu, always a pleasure. Many thanks indeed for joining us.
Thanks a lot, Harsha.
Thank you.
Good to speak to you.